All right. Well, welcome everyone to the FAR Masterclass of the 11th of March 2022. It's really great that you can all be here, and uh, it's actually interesting because today we have many more regulators than we used to have in other topics. But this, of course, the topic that we are discussing today about joint audits will attract the interest of regulators. That's for sure, and it's good actually that they've showed up here today. So welcome to all of you. We have quite a contingent on academics and an even bigger contingent of practitioners, and from a few of them we couldn't work out exactly what their background was, but you are all very welcome, and we are very much looking forward to a great discussion today. So, who are our presenters today? So we have two presenters. Jean Bédard will do the main presentation, and Alain Schatt will make sure that if you have questions that you will be able to ask the questions, which can either go via the chat or by raising your hand. And if you look on top of your screen, you will see that you can raise your hand there. So Jean Bédard of the School of Accounting of the University of Laval, and Alain Schatt from HEC Lausanne. And we are very proud that they are going to present their topic of today, which is looking at the economic consequences of mandatory. That's an important word we will learn today. Mandatory joint audits, because they will be discussing. I think also, that there is a difference in expected outcome when it is mandatory or not. So they will be talking about economic consequences of joint audits and also what are the political motivations for that. Some advice on the discussion. Ask questions during the presentation is my first recommendation. From our experience, it is just if you have questions, it really helps the presenters and also the other members of the audience. If you ask your questions live and do not wait till the very end, because that's just making the discussion much more lively, and also gives more feeling as to what aspects might have to get more attention. You can ask your questions live by raising your hands or via the chat. That's also possible. Then Alain might still ask you to speak up. So if you ask a question via the chat, or alternatively, he will read out loud what is your question. So without further ado, I would like to give the floor to. I would like to give the floor now to Jean. And Jean, here you go.
Okay. Hi, everybody. Thanks for the introduction. Can you hear me first? Yes?
We do, yeah.
Okay.
There we go.
So we're very glad to be here today to present our paper on joint audit and mandatory joint audit. This paper is with Alain Schatt from HEC Lausanne, like I said. Let me just share our slide here. Okay. So like I said, this paper is with Alain Schatt from University of Lausanne. Okay. So why did we look at the mandatory French audit, mandatory joint audit? This concept existed in France since 1966. It was introduced in the Code de Commerce, which is the company law of France. And it has been mandatory in France since that time. It also has been mandatory in some other country, in Denmark until 2005, and Canada for banks until 1991. Since that time, it has been removed in Denmark. In Canada, it has been removed, like I said, for banks. Banks have continued to do it voluntarily until the beginning of the 2000s, Canada, and in Denmark, few companies are still doing it. It was also proposed in the EU Green Paper after the crisis, and it was not adopted by the European Parliament. Since that time, joint audit has still went back and has been proposed as a way to modify the audit, the structure of the audit sector. So it has been proposed in the Netherlands, having the joint audit for multinational public interest entities or public companies, or another way, more as a peer review system. Same thing has been proposed in the UK by the competition market authorities in 1999, and again, it has been rejected. And following that, the government, the UK government, came with a proposal to have what they call share audits, which is the audit by another group of auditor, but only for subsidiaries or some subsidiaries, not the main companies here. So we see that there's a lot of interest in joint audit in the world. It has been there, and many countries decided not to have it anymore, and some other are proposing to have it back here. So we decided to look at whether this joint audit system is useful in terms of consumer well-being, in terms of concentration and price and quality of audit services. And this project was funded by FARS, and that's what we did for FARS. So we have a review paper that we did on the literature on this topic. Then we came back, and based on this review, we thought, why did the French still have this system while the other country have decided not to have it mandatory anymore, and why other country wants to do it here? And then it came to our question here is, why do the French regulator maintain the system adopted 55 years ago? And here, I might pause here and just ask some of the audience, why do they think that the French still have this system in place? Any suggestion regarding this? I don't see the raising hand, so if there's anything, Alain, tell me.
So Sander has Sander, maybe you can speak up.
Yes, of course. So I was just thinking about, would that be difficult to change anything in France? But it's just a thought, of course.
That's a good thought. That's a thought that we have, at least in Canada, when we see what's happening in France. It's very difficult to change anything. When it's there, it's kind of impossible to change anything that is there. Yeah, that's a good general answer here. Mm-hmm. Any other thought?
Maybe in France they successfully implemented it earlier. I'm not sure how was the situation in Canada or Belgium, but in French they have a long tradition regarding this question, and maybe they do it more efficient than auditors in other countries. In Croatia we have experience with joint audits, and we looked for the example of French colleagues. They really have the opportunity to split the work between auditors, so it would, in my opinion, it would not lead to such significant increase of costs if the work is properly split between auditors. So it could be the reason for French, and of course for the benefits for all participants of the audit market and independence of auditors.
Okay, good point. So you're saying that they have been able to implement it in an efficient way, and it gave rise to a better consumer well-being in terms of the investor as well as the companies here. Mm-hmm. Good point. Mm-hmm. So that's kind of what we're trying to look by answering those two questions. Question one.
Paul, is, so
yes.
Paul has a question.
Oh, sorry.
Paul.
Actually, no, it's not a question. I was just going to respond to probably the reason why the French are doing it is because maybe they just want to show that they have a different approach to audits and different from the rest. Yeah, and possibly it could be a good way to actually implement an audit. So they are just researching on a possible way to audit, and maybe it could be successful.
Okay, so the French difference here, or the French touch, and but successful one. Okay. No more comments. Okay, so we have some good answer to this, and that's what we're trying to provide here, based on the literature as well as on some of the work that we did as to the involvement of the French government and regulator in terms of changing or modifying the system. Our second question came when we were invited by the H3C, which is the French regulator, kind of the PCOB of the French, and on a consultation that they're doing on the joint audit. And in that consultation, they interviewed people from practice as well as academic. And Alain and I were invited as academic with another academic, which is Christelle Richard here. And during that consultation, they asked us kind of our literature review and what we found. And then there was a second conference, still by the H3C, what they call the Joint Audit Day, where I gave you it was filmed, so it's on YouTube now, so you can watch it if you want to look at this. And the objective of that conference was kind of, if you read the invitation, to initiate discussion on the promotion of co-auditing or joint audit in the European Union, and as a way to improve the French system. So you can see here that the objective of the regulator was not questioning should we maintain it, but more it's good and how can we improve it if there's anything to improve. So we just raised a bell and said, why do they want to keep the system here? Or why was it there in first and why do they keep it? So that's what we're trying to do in this paper. So the rest of the presentation will talk about the literature on this, so the economic consequence of the joint audit system. Then we will look at the political motivation of the French regulator and summaries as well as implication and future research. So what does the literature tell us about the economic consequence of the joint audit system? We're looking at three different types of consequence. First, one is on market concentration, then on audit fees and audit quality. So we're looking at those three types of consequence, the literature on these three types. In terms of market concentration, we all know that the market is concentrated. In Europe, the Big Four held approximately 60% of the market for the public interest entities in 2018. And for public companies or for companies that are listed on the stock exchange, this is more than 80% here, so much higher. If we look at the concentration, so having a concentrated market means that there might be less competition, and there's less competition, then it might have negative impact on the consumer well-being, meaning that there might be less price competition, lower quality, audit quality, or the relationship between price competition and quality might be not that good, and less choice for the companies in terms of the service provider that they can have here. If we look at the literature on the market concentration and competition, concentration does not necessarily mean less competition. There might be sufficient competition between the group of auditors, meaning the Big Four firms, to reduce or to avoid the payments of excessive price or an impairment in audit quality. Research has shown that there is a positive association between concentration in different countries in terms of the audit market and the quality. And when there is a competition between the big four, there's even more audit quality. So having the competition between the less concentration in terms of the big four, it improves the audit quality, meaning more competition between the four large auditors. Choi et al. Shows that this might vary in terms of the legal regime. This happens when you have a strong legal regime, and is the contrary when you have a weak legal regime. Here. Why do firms choose the big four? Why do large firms choose a big four? Big four have been shown to have better production technology, more resource, and a larger geographic coverage to perform the audit for those large companies, which are very often international companies with subsidiaries in many countries. They also have greater reputation in terms of the stakeholder. So stakeholder, they provide more credence to the financial statement of those companies towards the stakeholder. And because they're perceived to better resist managerial pressure and have more reputation to lose, as well as, at least in North America, deep pockets here. What do we find here? In terms of joint audit, in France, what was expected is that joint audit will dynamize the audit market, allowing mid-tier firms to come and compete with those large big four here. What does the study shows? There's less market concentration in France than in the rest of Europe. If I give you here some statistic on the right for the 2017, and you can see that at the bottom, the Euronext Paris has less concentration in terms of the number of mandate here, and but more in terms of the audit fees. Okay, and it's lower than in the other country, but in terms of the audit fees, it's still quite high. Okay? As in the other countries, the concentration for fees always higher than the one for the number of audit. Why? Because Big Four audit mainly large companies, meaning large companies will pay more audit fees, which means a higher part of the market. So in terms of the share by the number of audit, it's much lower in France than in other countries. But in terms of market share, it's not that low. So we have, yes, lower concentration, but not that so low here.
Okay, Jean, there's a question by Jan.
Jan, go ahead.
Yes, thank you, Jean and Alain. So I find this economic argument, of concentration an interesting one. There's actually literature that has looked into concentration in banks, right? And you do see there that there's more competition, but on the other hand, when there's only a few firms that compete, for in this case banks, they also take much more risk, and maybe taking more risk than that is desired from a societal point of view. So, and actually, I would be interested, to see what is your view on that, right? Is there some indication that auditors might be taking more risk than we would like them to take when it comes, for instance, to accepting clients, to to see how big their effort should be to complete the audit and these kind of questions.
Okay, but
I don't know whether it's the right time. Maybe later on that you are going to focus on that, but that because you were talking about this concentration and how that might impact actually the competition. I thought.
That's a very good question, a very good point. That we have a kind of oligopoly of four firms. So what is the impact on that? Normally, there's less investment in development of new technology and everything. Economically, I know, like you're talking about the banks in Canada, we have a very concentrated market for banks, and our neighbor, the US, they have a lot of banks, many more. And what studies have shown is that our banks are much more conservative than the US one because there's less competition and the regulator is more involved in terms of those banks. So when you have an oligopoly, there's a lot of weight that is on the regulator to be sure that there's competition and they don't play the market. So it's kind of contrary to what we see. And what we saw in the literature is that many are complaining that if you have an oligopoly like this, some big four will not want to have those risky clients and they will leave them to the smaller firms. So it's kind of even the contrary to what you're saying. But there has not been, to my knowledge, many study on this issue in terms of competition and the acceptance of clients. So that's an interesting area. But like I'm telling you, there's a difference here in terms of, at least if you look at the banks in Canada. And we have the same thing with the cellular telephone, or mobile phone. There's an impact on price.
Yeah.
If you have more competition, lower price. At least enough players in the field. Mm-hmm.
Yeah.
Jean, I would like to add something here. To your point, Jan, usually people compare the banking system and the audit system, but there's a huge, huge difference. The systemic risks, you're talking about systemic risk at some point when you're talking about banks, right? That's the main difference. But systemic risk exists when you have connections between companies. You lend money to another bank, so if you fail or the other bank fails, you may fail. Okay, that's the issue. But as you know, there's no connection between EY and PwC or Mazars. There's no contract between this company. So if Mazars fails, EY will not fail. There's no link between these two companies. And that's a huge difference between the banking system and the audit system.
Yes, yeah. You talk about syndicated loans and the like.
Exactly. For example, just contracts derivative, you sell derivative to another bank, I buy derivative from another bank. This kind of contract does not exist in the audit market, okay? So there's no interaction between auditors. And so that's why there's no systemic risk. And when you look at the answers provided during the green paper, the comments for the green paper in Europe in 2010, a lot of people agree there's no systemic risk. Even regulator says there is no systemic risk in the audit industry. I mean, we can discuss about that. Of course, it's a big issue because if there is a systemic risk, then we should manage it, of course. But as I said, since you don't have contracts, if one auditor fails, it will not imply that another auditor will fail. Okay, that's my point. I would like to add here.
Yeah, well, the main motivation in these papers, they were by Bushman, were that banks were protecting their market share. That was the main reason why they took these risks. And that might also be a worry within the audit profession.
Okay, so but what the studies show, at least for the big four, there's no one of the four players have a large or a predominant position in the market. They kind of share this market mainly between the four, plus or minus 5% or what. So there's less competition. What is the impact on the cost of audit services? Having mandatory joint audit predict that there will be more competition because there's more players that will come, so the market share is lower. So they expect that the cost of the audit will be lower, having more competition. On the other hand, having a joint audit means that there's cost because there's two auditors auditing the company. So there's some work that is duplicated that you have to share, and some that you do by yourself. And so normally the work that you share in a joint audit is in the planning of the audit, and then at the end with what they call the cross review of the audit and discussion that you might have. So there's two forces playing here. Which one do they balance each other? Maybe it's zero, maybe it's more, maybe it's less. We don't know here. So we look at the empirical research where some studies have compared, we need a control group, so have compared joint audit with single audit, and also the difference between the pair of auditor here. So what does the literature tell us? Well, there's not that many studies that have compared France with other countries. So one of the studies that has done it is André et al. In 2006. They have compared the French cost of audit for with the Italian companies and the British companies. So if you think about Italy, that's a similar institutional context environment, the French one, and the British one is more Anglo-Saxon, so there's more liability and lawsuit risk for the auditors than there might be in Italy and France. And what they find is that French companies pays about 30% more for the audit than the company from these two countries. So 30% is high. Okay, so that's the cost, supplementary cost of it. It's kind of in line with what was shown by Mazar case studies, where they compare or calculate the cost of a joint audit for their clients, and they indicate that it's approximately between 10 and 15% higher. Here we have much more than that. It's 30%, what the empirical literature is showing us. So what do we learn is that, yes, the cost is higher compared to a single audit based on the literature that we have here. Any comments on this? All have experience with joint audit and want to share it?
I think that Anton Dillman has a point here.
Yeah, Anton? I think Anton has a question.
Yes, good afternoon. Sorry, I've gone from unmute, but I think Auke was before me. So Auke, you can first ask your question. But I think Auke have a more intelligent question. I have a very simple, small question. Is it realistic to compare Italy with France, given the cultural, economic differences, the differences of the regulator, etc., etc.? There are many differences between Italy and France, I assume. Can you give us a bit more background information about this issue? Thank you.
Yes, it's a very good point. That's always a problem when you try to test the difference between or the effect of a, let's say, joint audit, because you need a control group. And your control group, you hope that will be very similar to the one that you're looking at. But there's not that many countries that are similar in the world. So we always control one country with the other one. The other way to do it is when you have a shock, so moving from single audit to mandatory joint audit. Okay, so, but it was in '66, so there's no information on the auditor fees at that time, and there was no study. So yes, it's a problem because Italy is a little bit different from France. There's difference in France have a lot of regulations asking the auditor to do some work that they don't ask in other country. UK have different regulation, and you have to report on some other thing too. But when you find for two countries that are like at the kind of other one that is more similar to France than the other one, and you find that you have this premium in both cases, that's a strong indication that there's an increase in cost compared to a single audit. And when you correlate this with the Mazar case, then it shows that there's something there. Okay, what is the real amount? We don't know. Okay, they talk about 10, 15. Here, the study showed that might be up to 30%. I saw a report where some people were talking even about 50% increase in some cases. Some clients said that, but it's perception. At least here we have some number to raise this. But it's a very good point that that's one of the limitations of those studies.
Thank you very much. And to be honest, I'm a member of Mazar, but that's not relevant for this question.
Okay.
So we have another question from Oke. Mike, you mic. Turn on your mic, please.
I can mute. You mute.
Yeah, okay. There I am. Sorry. I'm a board member at EY in the Netherlands. And I not really have a question, but I want to react on the 30%. I recognize the 30%. I recently reached out to the French colleagues. Is it 10 or 20 or 30%? And I think 30% is still actual. And recently we did a joint audit in the Netherlands together with another big audit firm, with Deloitte. And what you see is that that you can't rely completely on the other accountant, on the other auditor. You have to do certain procedures, or both parties has to do certain procedures and have meeting with those charged with governance, etc., etc. So on certain points you do the work twice, And on the other hand, you can rely on the work of the other and review. So that makes that it is more, I think, 30% than 10% in the number of hours. Yeah.
Okay, that's a good point. So it's not only in terms of planning and review at the end, but there's some work that is kind of duplicate between the two. That's what you're telling us.
Yeah.
Okay, interesting. Thank you.
Okay.
Any other comments? Perfect. So there's an increase in cost versus single audit. Does this vary between the auditor pair? Okay, so because you can have normally what you see, you have a big four with a big four with a non-big four, and even between the non-big four, you can have like the second tier and third tier firms, and then you can have all the pairs that goes with this here. So the study that looked at it, there's an Andoucet-Coulier in 2015 that find a fee premium when you have one big firm compared to non-big firm, and no marginal premium when you have two big four here. So what does it show? First, we have to observe that in the single audit literature, almost all the studies show that there is a premium for the big four compared to a non-big four. So here the question is, if you have two big four or a big four with a non-big four, how does it play in terms of sharing the work? Does the comment that we add that we have to repeat or redo some of the work or duplicate the work that is done with the other auditor? So is it different when you have two big four versus a big four and non-big four? Maybe so that might bring higher cost here. Andoucet Coulier is data from the beginning of the 12-10, and we have more recent data with André et al. And a study with Alain Schatt here, that we find that the presence of one or two firms significantly increase the fees, meaning that there's a big four premium compared to a non-big four firm when you're audited by two non-big four firm here. Again, any comments on this from the audience as to, is the work different when you have your second audit firm is a big four if you're a big four versus having a non-big four or a smaller firm in terms of the partner? Because a lot of French companies are not audited by second tier firm, let's say Mazars or some other, but very small firm. So how does it impact the work that is done by, let's say, the largest firm in the pair? Any comment on this? Does it make sense? Okay, so I don't hear anything.
Jan.
Oops, sorry.
I think from a point of view, I mean, if it is if you think of it in terms of the purpose of one of the purposes for introducing joint audits is that you want to decrease the market concentration. And if it's then the case that it's likely that other smaller firms are then invited to join on the joint audits, right? That might actually be helpful in that respect. So apart from whether the audit as such improves, or the audit quality as such improves, right? If it is that you're pursuing lower levels of market concentration, that seems to help then, right? If that's the case.
Okay, yes, we'll come back to this comment a little later in the presentation where we talk about the situation in France. Okay, so that's a very good point, because you want to bring another firm, okay, that will learn and be bigger, we hope, and be able to compete with the big four. So
and I think that's a big argument that is being put forward in the UK in the discussion over there.
Yeah, exactly, and that's an argument that is being brought in different countries, not only in terms of audit, but we saw it, at least I saw it here in Canada with the engineering firms, try to help the Canadian firm to grow and compete in the rest of the world and everything. So it's kind of subsidizing or helping those firms to grow and be able to compete. So yes, that's an interesting way to see it. But here we're talking, yes, that's perfect. But what is the impact on the cost here, okay, for the audit? Does it bring, if you have a smaller with a big one and you want to teach them how to do the audit or to grow, so what is the impact on the cost here? And
that's a fair point.
Okay, perfect, thanks. Yeah. So that's, studies kind of show that there's more competition or less concentration. There's higher cost that is associated with the joint audit. Okay, we're talking about 30%. That seems to be a number that is not that far from the real range here. And then what is the impact on the audit quality? Does it improve the quality? Does it decrease the quality? And there's different point of view on this, okay? There's what they call the 4 eyes principle, where to have 2 group of auditors that are independent, there's with different competency and knowledge, there's the higher probability that you will find an error, detection of a breach, and there's also greater independence, because what is said is that there's more, it is easier for 2 auditors to resist managerial pressure than having a single auditor. Okay, so that's on one side. There's also another side of this. Okay, there's having 2 auditors, it's more difficult to look at the work and plan the work that they will be doing to ensure the quality that the work that the other auditor will do. There's also, you can also free ride on the work of the other auditor, on their reputation. So there's also a risk that the quality might be lower. So we don't know what will be the impact on audit quality. There's 2 forces that play here. But studies normally define the audit quality that if you find an error in the financial statement, you will report it and change the audit report in that case, or ask the company to modify the financial statement. How do we measure it in reality? It's very difficult. Mainly is a lot of people use the accrual to measure it, to measure it, as in many studies here. A limitation of the empirical research in that way is that first, when we measure the audit quality with the financial statement as the output, the financial statement are a product of the company and the internal control system and governance system, as well as the country, like we said before, that regulated, and then the auditor that comes. So it's a joint product, and we cannot differentiate the impact of the company and the auditor. And that's problematic when you think about the audit market, because Big Four, normally larger firm, audit larger company. Larger companies have been shown to be less prone to errors because they have better internal control system. So in the end, is it like a selection bias, meaning that good company choose Big Four? So the result that we find is caused by just the selection because of the company, or because the auditor adds something to it. So that's the problem that we have in all those studies, not only for the joint audit, but all the audit quality studies. So we have to acknowledge this limitation here.
Jean?
Yes.
I think David had a question. I don't know if it was about concentration or about audit quality. David, are you here?
Yes, hi everyone. A couple of comments maybe on what's been said so far. One on very briefly on cost. Sorry to go back to that. I had my hand raised maybe a little bit late. But I think it could be useful to consider the recent market dynamic in relation to competition. What you can see, for example, in the large PI audit market in the UK in the last 2 years, that companies have had audit fee increases forced on them of probably between 20 and 30% on average, whereas in the French market, comparatively, it's probably been more like -5 to -10%. So competition can have an impact on prices, and all of the studies you mentioned predated these recent developments.
That's a very good point. One of the limit of the research that we're doing, that when somebody find a result like 10 years ago, it's very difficult to replicate it like in the context of today, unless you have a very good reason to do it, because it's more difficult to publish. Okay, because they always say about your contribution is lower. But it's a very good point that you bring here, is that the context is changing and the world is changing. So we need, so if we want regulator to make decisions that are based on research, we need some recent and more relevant research to be able to give them advice, and so that it will be useful.
Yeah.
So it's a very good point. I think we need to look maybe more at the recent context. And like you said, if the context has changed, it will be interesting to see what will be the impact on the audit fees.
And I think just to finish on cost, I think it's potentially misleading to have just 1% across all of the market, because I think there was a study from Audit Analytics that showed that the difference between single audit and joint audit on cost varied depending on the size of the company. So I think you have tierings in the market, and you may have some tiers where the difference is far less than 30%, and possibly some tiers where it could be in excess of that.
Mm-hmm.
And I think that tiering is quite helpful, I think, when we talk about the cost of joint audit.
Good point. Yes, I think tiering is interesting, and because the size of companies plays here. And I think tierings could be interesting in terms also of the non-Big Four. Most of the study just consider the non-Big Four as a group, and as we will see later, there's kind of two types of non-Big Fours. There's Mazar, and maybe one or two other study, and even there, and very small firms here. So the cost might be different, and even in terms of quality, there might be an impact here.
Yeah,
very good point.
I have a question for David. You said in France the prices are declining, and in the UK it's increasing a lot, right? That's what you said before. Do you know why it happened?
Well, it's always difficult to say, but there are different dynamics from the competition point of view.
Okay. But could it be litigation risk, for example, that changed in the UK after carry-on case?
I don't think this is connected, honestly. Okay. I think you may have increased regulatory pressure, perhaps, driving prices up, but it becomes quite a circumvented issue, because you mess up, you have more regulation, therefore you increase your prices, and the root cause is not always very clear then.
Okay, thank you.
Okay, so research should look at that and try to understand why, at least acknowledge this fact, and look at why it might happen. Yeah. And also maybe a point, you're talking about public interest entities, but most of the research is always on the one part of the public interest entities, meaning the listed companies. So the other part is not very well studied in terms of the research literature.
And Jan has a question also on the chat. Jan?
Yeah, I mean that's so we compare joint audits, right? I was wondering, there's a lot of joint audits also happening in non-mandatory fashion, because many firms, when we talk about group audits, use actually component auditors, right? So what is the defining difference between a joint audit, as we are talking now, and a group audit with component auditors also involved?
Okay, that's a very good point here, and it goes kind of with the UK recommendation to have other auditor for the subsidiaries or for the components. What the research is telling us on this is that first, there's some, if you look at the international standards, there's some review work that you have to do, okay, and some planning. So that maybe there's some similarities between the two. But in terms of liability, it's very different. The auditor that is in charge of the group is the one that is liable, and his work is he will be judged on the review work that he did on what the other auditor did. Okay, so it's not a joint liability between the group auditor and the subsidiary auditor. that's I think that's one of the main difference, and that's why the UK came with this idea of share audit, so that smaller firm would not be scared of the liability that goes with the joint audit. And in terms of study this, I've seen some working papers in the US, since now they have the name of the auditor that are part of the group, meaning the one that audit the subsidiary, and we know the proportion of the audit that is done by those people. And studies, I'm not that much aware of the literature, but my understanding is that when there's too many other firms involved that are not part of the main auditor, the audit quality decreases. It seems that those studies start to show this. Okay, but it's very preliminary. But I think that's a very that's something that should be studied, comparing those two. But it doesn't seem that it's so a good thing. Maybe I know there's some practitioner and regulator in the audience. Maybe you have some experience that you can share with us about this idea of having a different auditor to perform small or large part of the audit. I know that in some group, from my experiences, I had some case where 80% of the audit was done by another auditor, which is quite risky for the auditor in charge here. Any view on this?
I can comment on that. For example, from our risk at EY, our risk policy is that you must try to audit 100% of the audit, because if you don't do 100% of the audit, there is always the risk that you haven't seen everything. And so when we look at the frauds in the past, you saw that, for example, certain parts of certain components were audited by another audit firm, most of the time a local audit firm, and there the fraud occurred. So from our risk policy is that we, in the end, we want to do 100% of the audit.
Mm-hmm.
Any other comments? Okay, thanks. So it goes kind of what I said. There's a kind of a risk issue that is there, and it goes with maybe what the starting literature on this issue in the US, where you can see that there might be some more risk and lower quality when you do this. Okay, so no other comment. Okay.
So there's no. Sorry, I feel I've got to say something there. It's yes. David again. But I think it would be unhelpful to suggest that joint audit leads to potentially more fraud, because there is absolutely zero evidence of that, and we've seen a lot of frauds where the auditor was auditing 100% of the business. So I think we need to be careful about how we portray fraud and joint audit.
Yes, good point. Actually, there has been no study looking at fraud, and there's not been that many fraud in France. Maybe, and it depends on the type of regulation. We don't know. There's no study because in France there's almost no restatement, so you cannot look at restatement. That's why our indicator of quality are quite limited when you look in France here. Okay, so it's difficult to compare. So it's really, at least what we know is that based on at least those studies in terms of across, there's no difference in earning quality. Okay, there's no improvement and no decrease in audit quality. But it's a good point, David. Mm-hmm.
Yeah, and maybe to comment, it was not my point that I say when there is a joint audit that there is a bigger chance on fraud. My point is more that the current policies at EY, and I also know at the other big four, is that we want to audit 100% of the audit, because we think the assumption is that you then reduce the risk on fraud. And yeah, okay, that's the current policy. That's the point that I would like to make. Yeah.
Okay. And like I said, it's preliminary results.
Sorry, just to Jean. Yes. Just a comment for David. When you said there's no fraud, I remember this case, Mami Cassoulet, and I think it was PwC and Mazar, and there was some fraud in that case, right?
Yeah, I mean, fraud happen all the time. What I was saying is that there is no evidence that joint audit results in more fraud.
Okay. But I mean, in the context of joint audit, like the French context, you have also a case of fraud, which is this case, right? It can happen also.
It can
maybe happens less. It's possible that it happens less, but it can also happen.
It can happen. I didn't say that joint audit prevents all frauds. I was just saying that there is not necessarily a correlation between.
It's a good point, and here actually the point that was made was in terms of subsidiaries. If you have another auditor for subsidiaries, what is the impact for the main auditor? And there's some policy in firms that to manage your risk, you want to have most of it, and studies shown that they might be lower quality. There's no link with joint audit here. Okay, but this issue has not been studied in joint audit. Okay. Let's move on here. So what does studies show in terms of the pair of auditors? Okay, most studies show there's no difference in terms of the pair of auditors, except for two studies, one by Francis that look at the data in the I think 2006, where they found that Big Four, there's higher quality when you have a Big Four, two Big Four, a pair of Big Four, for income increasing discretionary accrual. So meaning that you're trying to manage in the income to positively. There's an interesting study by Lobo et al. Who instead of looking at discretionary accrual, they look at the goodwill impairment and affirm that based on the environment, they should have book an impairment. And they found that when you have a mixed pair, meaning a Big Four and non-Big Four, you are more likely to book a goodwill impairment and you book a larger amount of impairment. And they also found that when you have two Big Four, there's less transparency, meaning that there's less disclosure about the impairment when they book the impairment. So that's an interesting study because it looks at something else than the discretionary accruals, more direct, and with maybe some better reason of why you should book something here. So there might be, in general, there's nothing that is found, and there might be an improvement depending on the pair that you have here. But there's no comparison actually between joint audit and single audit. So it's just playing within the pair. So it might give information as to which type of pair you should have when you do this. Again, when you take a non-Big Four, like I told you, there's large non-Big Four and there's small non-Big Four. So that might be, there may be a difference here, but it's not a part of the study. So what do we know from the academic literature? Moderately lower market concentration, no significant benefit, at least there's no decrease in quality, okay? But there's an increase in cost of the audit, okay? We're talking between 15, 30%. 30% seems to be like a consensus level, but there's an increase in fees. So when you look at this, you have the same quality, higher cost. Why did France keep this system that was adopted in '66? Okay, while other countries have decided to abandon that system. Like we said before, might be the French difference. It's difficult for France to change things. Yeah, there might be some valid answer. So we decided to look at this issue a little bit more. So how did we look at this? We look at the regulator motivation. So we did a content analysis, meaning that we read the debates of the French National Assembly regarding joint audit when it was adopted in '66 and when it was changed in the '80s. And we also look at the comments letter from the auditor or French auditor regarding the EC proposal, the green paper, regarding the joint audit system, okay, which was proposed to have a Big Four and non-Big Four to limit the market concentration. So what did we see? First, if we look at the adoption of the joint audit, it was adopted in 1966 when the French regulator, French government actually changed the company law. So there was not only a change in terms of the joint audit, in terms of the audit, but there was a lot of other things in the French law that was changed. The objective was really to modernize the company law because the world had changed with Europe and everything. So they wanted to have something that was more modern than what they had in, I think, in the 1800s that this law was dating here. So if we look at the context, modernization, because the French had to modernize their law. In terms of the auditing, okay, at that time, there was no firms, or the audit was not like in the, let's say, the Anglo-Saxon world in the UK or the US or in Canada. Okay, it was mainly a matter of individual, okay, who, like I said here, that's a citation from the Commission des Opérations de Bourse, which is like the securities, it is the securities regulator, okay? They were like a member of an independent professional, liberal professional who operate alone. So meaning one individual was doing the audit, okay, of many companies, often large company, confirming themselves to superficial check. So there was very limited work that was done. Ramirez in 2003 just characterized the statutory auditing at that point as simply pointing of the accounting document, okay, carried out by professional without really real means of investigation. So you compare the books with the financial statement and or the invoice, and this was it here, okay? And this inferiority of the French audit was kind of recognized by, let's say, the rest of the world, because when they had a subsidiary in France, okay, what they said that time is that the headquarter and the auditor of the headquarter of the firm normally use the service of their auditor to audit the subsidiary, okay, in order to consolidate it and not use the French auditor in that case. So really the motivation at that time was to improve when you look at what is said in the Journal of the Debate, really the objective was to improve the quality by performing more resource to the firm in order to perform the audit. So they allow them to have two different auditors, so that way you have more resource, and if you have more resource, you can perform a better audit in that case. Then, in 1984, there was a revision of the company law, but it was revised because they were doing something towards the bankruptcy. But at that time, when they decided to add some issue regarding the bankruptcy, the law regarding the bankruptcy, the government decided to remove the joint audit requirement for listed entities. Okay. Why? Because the COB, which is the securities regulator, insisted, okay, that's the government that said that, insisted on eliminating this obligation because of the resulting costs for the French companies here. So they were complaining that was costing a lot of money and it was not that useful here. So they proposed to remove the joint audit requirement for listed entities. That was proposed by the government. It went to the Senate, National Assembly, went back and moved on and on. And after the debate at the end, it was joint audit were maintained. So the government changed their view on this and decided to maintain the joint audit and ask it only for firms that consolidated the financial statement and not for all the companies. So why did they do that? What was the motivation? This is what they said at the French National Assembly. Okay, the current auditor must, because of the present at his side of as another auditor, exercise due diligence. So 2 eyes, okay, or 4 eyes. In the event of conflict with senior executive, the opinion of a college of auditor has more authority than that of a single auditor. Actually, this citation was used by the French regulator not so long ago when they explained the advantage of the joint audit. So really the objective was to improve quality. That's the argument that was brought by different person at the National Assembly. Then, in the end, what they say, okay, French company will be tempted to take as a sole auditor the firm whose signature is recognized at the international level. That is to say, an Anglo-Saxon firm, meaning a Big Four. Okay, this situation will therefore penalize French firms and reduce their possibilities of expansion, reputation, and influence abroad, which could be contrary to our interest in the current economic and financial situation of our country. And that's the argument. In the end, that's really the argument that made the French government change their view on this and decided to keep the joint audit. Any comment on this? Are you surprised with this?
It's always difficult to make changes in an existing system, right? With all kinds of signals that might come about if you change the system. So surprised, I don't know. It's just being cautious, I guess.
Okay. But on the one hand, they really wanted to change it. That was a proposal of the government, and they could have changed it because they have the majority. Okay, so they could vote for it. But then after discussion, and we don't have information of all the lobbying and what was behind that here. Okay, but in the end, a couple of months or a year later, that's the conclusion that they came on, and that was really protection and to be able to have French firm that will compete at the international level here.
Yeah, can I add something, Jan? Just to understand, what we were looking at when we went to the H3C, day about joint audit in Paris, we were very interested by what was happening there, in the sense that all the people talking about joint audit were in favor of joint audit. And nobody was against joint audit, which is surprising when you have 6 hours about joint audit. All the good arguments in favor were put here and nothing against. And so we had a long discussion with us saying, why does the regulator select these people, only people in favor of joint audit? So is there some kind of, conflict of interest here? I don't know, some lobbying going on in France. And so that's why we are starting looking about this discussion at the French Assembly, okay? And then we found this, and we were very surprised, to be honest, at the first time we found this. And now we understand we think we understand a little bit more why we still have this system. It's a way to protect small firms, and which happens in a lot of countries. In the US, in China, you protect your own companies. So what's going on in France is not different from what you can find in other countries, maybe in other industries, but the idea is the same. We protect our own companies. That's a main issue and something's pretty new we found here.
Maybe to add something on this, when we were at the first meeting with the H3C, we had comments that we were against joint audit, Alain and I, but I'm not against it or what. It's just based on the literature that this is the fact and what is there. So that's your choice after that. And that maybe to add to Alain's point also for the joint audit day. Okay, what really they see the invitation that I said before. The H3C wanted to initiate discussion on the promotion of co-auditing. Okay, so it's really the objective was promotion. So that's why we were not invited to provide our result or the result of literature on this. Probably maybe not, because there was not necessarily a promotion in there. But I think it just
but that is political lobbying, right? Because this is also what we see in the Netherlands when it goes on the schooling system. We have this people in pedagogy that that really want to impose like this middle school type of idea, and they always get the floor. Right, exactly. That's political decision making, which is also very much impacting this discussion.
Yeah, it's true, because those are political decisions. Because as we will see later, there's a benefit and cost for different parts of the stakeholders, and so as a government, you need to make a decision as to who will get more and who will get less. And every decision that you make penalize some group and give advantage to the other one. So that's the objective of politics. But I think the point that we wanted to make here is that there's not only the, like I said, the economic point, that there's a kind of the political economy that plays a role here in the decision making, and that as researcher, we need to not only to be aware of that, but I think we need to study that and make the stakeholder aware of this, okay? Because there's an impact also this on the economy. Okay, and then we look at the comments letters that were sent to the European Commission, okay? And we compare the Big Four, the non-Big Four, and the other stakeholders. But as you might expect, okay, the firms that have something to gain were for it, and those that had something to lose were against it, okay? And so the non-Big Four said that it reduce the market concentration for the audit of the large entities, reduce systemic risk, and then promote financial stability. And this will be done. It's perfect if you have this, but in order to achieve this objective, you need a more balance of work between the Big Four and non-Big Four, because at that time, the Big Four were capturing a larger percentage of the fees when you had a joint audit. So they wanted something that was more balanced, so that the non-Big Four will get a larger part of the share. On the other end, the Big Four, okay, they were for the, let's say, the free market. Okay, so companies should have the freedom to decide to appoint one or two auditors if they wanted. Okay, I can tell you the experience in Canada, like I told you, the companies, the bank kept their joint auditor for almost 10 years, and just after Enron, they all decided to abandon the joint audit and move to a single audit. So, and same thing happened in the Denmark. Okay, Big Four was saying there was an increased cost at having a joint audit, and that's what the literature kind of shows also. And they talk about negative impact on audit quality in their comments here. Okay, because of the there's always a part of the work that you're not doing, so the quality might be lower depending on the type of auditor that you have, on the quality of the other auditor that is chosen by the company here. The other stakeholder, but there was the H3C that gave his opinion on this, and they see that it provides the emergence of other players and a greater independence, so the argument that we already heard before. And investor and preparer were really concerned about the increased cost of joint audit, and they were not talking about the other one. So we can see here there's a lobbying. We're talking about political decision. So this group were lobbying, and we see that there's some people that win. Okay, let's say the non-Big Four, the Big Four lose, and the other stakeholder, the companies pay more. Okay, and do the investor get better audit quality or better financial quality? They're kind of concerned about the cost here. So are you surprised about with this comment here?
Yeah, and we can add, Jean, maybe that there was a big consensus between non-Big Four and a big consensus between Big Four. So non-Big Four were all in favor, and Big Four were all against, which is amazing. And usually all non-Big Four said, yeah, we need joint audit and we need to share the revenue. So the time spent on the audit and the revenue. So we can see there's a real conflict of interest here between Big Four and non-Big Four regarding this joint audit issue.
Okay, so we saw there's kind of a political, and one of the issue that they said, okay, it brings, like I said in the previous slide, it gave the emergence of other players than the Big Four. Okay, and also it reduces systemic risk when you have another non-Big Four, another large firm that is there, because if there's one Big Four that goes bankrupt, okay, or go out of the market, then you have the other firm that can just go there and do the audit here. So let's look at this. So we decided we wanted to just look a little bit more about this market share. So what we had, and we collected, in part of the study, we collected the information on the joint audit or the auditor in France, starting in 2002 to the end of 2017, looking at the audit fees and the auditor that were auditing those firms, okay, for that period. So we have more than 11,000 mandates, or 5,600 companies years that are looked at. So we provide here the data for the year 2003 and 2017. Okay, if you look in terms of mandate, okay, the Big Four have 47% of the mandate, and in 2017 they have 53% of the mandate. For the fees, it stays the same. If you look at Mazars, then Mazars is the other player that was able to raise in terms of with the French joint audit system, and it's like I said, the joint audit started in '66. If we look at 2003, they had 6% of the mandates and 5% of the fees. In 2017, that raised to 12%, with the fees almost equal here. And the other firm get 47% of the mandate and 35%, a little bit lower in the 2017 of the mandate again. For the fees, it went from 12 to 5%. So what do we see here? There's another large player that came out with 13% of the fees in 2017. That's a share that is as big and even bigger than some of the Big Four here. So Mazars is a large player in France. That really changed and became a large player. But there's no other large players in France. Like if we look at the statistic here in terms of number of mandate, we just take this 47% and this 35% and look at the number of mandate by those audit firms. And there's more than a third of these mandates that are for firms that only have one listed company client. Okay? There's more than half of those companies that have 2 to 10 mandates. So let's say that about 2/3 or 3/4 of those audit firms audit less than 10, have less than 10 mandates. So audit less than 10 public companies or quoted companies. The question then is, first, can these companies, these audit firms, reduce the systemic risk? So meaning, can they replace one of the large Big Four firms in case one fail? And what is the quality that is brought with this? How can an audit firm that only have one public companies knows about the IFRS, all the regulation that goes with these public companies or quoted companies, and do the same type of quality audit? Okay, so what we're telling here is that the non-Big Four audit firm are very different. They're different tier or type of firm. Okay, there's Mazars, let's say, and then there's the other. If you look at the other, okay, those that have 11 and 50 mandate, there's only 2 firms that are there. Okay, and these firms are my notes here. Okay, are Grant Thornton. Okay, Grant Thornton have 5% of the mandate, 1% of the fees in our sample. There's RSM, which is just 3 different RSM in France. They have 3% of the mandate and 1% of the fees. If we compare 1% with 13%, so they're very small. So there's the French joint audit system was able to have one firm grow, while the other firms that had the same possibility because they were in the same joint audit system, did not grow. Okay, they stayed small compared to the other one. So one of the questions that we can ask is why Mazars was able to increase their market share like this and be a continent to the Big Four in France, and the other firms did not. So that's one of the questions that we have. And yes, we can agree that the French system was able to let one firm grow, but not the other one here. I don't know if any people in the audience want to share their view on this, or have some explanation as to why Mazars was able to grow, why not the other.
Sorry, I was just saying that the system provides opportunities, and after that, it's down to each firm to decide what their strategy is vis-a-vis these opportunities. So I can only say that Mazars thought that this market was strategic for it, and possibly the other firms didn't.
Okay, yes, good point. I know that when if you watch the H3C joint audit day, there was a regulator from Germany who said that many of the smaller firms in Germany did not want it to grow. They did not want it to do like Mazars and grow, while the other that Mazars did it. So maybe it's a strategy from one firm versus the other. Any other view on this?
Emeline has a question. Emeline? Emeline has a question in chat. She said, was Mazars already bigger compared to the other big four in 2003?
No, Mazars compared, but the big four was smaller, as you can see from the statistic here. They had 6% of the mandate. Okay. And compared to the non-other big four, there was some other firm, okay, that were there, some other French firms. Most of them merged with the big four, okay, and some of them merged together and went with Grant Thornton. Okay, so there was no really nothing like what happened at Mazars. So they use a different strategy.
Okay, because I was thinking if firms don't want to have two big fours, then they will just have one big four and one non-big four, which at that time was the biggest one. So then they will go to Mazars, and that's why Mazars managed to grow compared to the other non-big four. And then I have another point. Since audit firm cannot provide both audit services and non-audit services, if firms have two big fours and then they use another big four for non-audit services, they may be too much related to the big fours. So maybe that's why they go to non-big four firms, like they have one big four and maybe Mazars for the audit services.
Yeah, that's a very good point here. Okay, there's two. You just said 2 points. Why Mazars was able to grow between 2003 and 2017 and not the other one. I know that many small firms just went out of the market. Okay, so that's a difference. So there's less audit by a big four and a very small firm. There's more about big four and medium firm and less very small firm. So that we're doing audit. Like you can see, if you look at the red here, it almost reduced by half. So firm that only had one mandate went out of the market mainly. So that was a change, and that's Mazars that got it, and some other firm, but not that much. And then the idea that yes, and that's an issue, having if you cannot do consulting as a big four, okay, but maybe you don't want to have two big four. The company might decide not to have two big four, or even one big four not want to be auditor of that company. And that was one of the reasons that, at least in Canada, when the bank in the beginning of 2000, decided not to have joint audit, the reason that was given by the bank is that they wanted to keep one of the auditor as a consultant. And remember, in the 2000, that was after Enron, so they reduced the consulting service a lot. And one of the auditor, I think it's Price, just decided to quit joint audit because they wanted to be consultant and not auditor at that time. So that's why they moved from 2 to 1. So that's an important issue. And actually today it's an issue because when you change auditor, you don't want an auditor that was consultant the year before because they cannot be the auditor in that year. Okay, so that's an important issue with the joint audit. Any other comments?
Yeah, David, hands up. David, your hand is up.
Yeah.
Yeah, so you made the point already, but I think the impact of local mergers should not be underestimated. You know, there were, if you go back to 2003, there were a number of large firms in France which no longer exist, and they had the ambition. They were very good in the market you're looking at here, but they preferred to take a check than to deliver on a organic growth strategy.
Yeah, it's a good point, and we see it in the paper. We look at those firms, and many of them merged. The contender merged with the big four, and two of them merged together. So they were quite important, but more important in the end of the 90s and beginning of 2000. But then really Mazars continues and had a different strategy than the two others, or the two. There were 4 or 5 others contender. Yeah. Good point.
But in fact, David, you raise another issue here. Should the regulator forbid the Big Four to acquire other smaller companies, for example, to dynamize the market?
Maybe it's too late now.
Yeah, okay. Mm.
But the question is, does the market need to be dynamized? That's another issue. But at least we see that there was no other contender for different reasons, but mainly strategy from the firm, different strategies. So there's one firm. So we all agree that France was able to get one firm, Mazars. When you look at when we look at the statistic worldwide, Mazars is not that big in the rest of the world. That's a large firm, but they're not that big. Grant Thornton and the other are bigger. Okay, but in France they're small, much smaller. So it really helped in France, but not necessarily in the other countries. So maybe it depends on the strategy, but that could be interesting to study the growth and the strategy of those non-Big Four and see why and what happened and how do they compete in the rest of the world and in France also. Now let's look at the wealth transfer. So we said before that there was when you have a joint audit, there's some winner, there's some loser. So we want to know, we know that there's a higher cost. Okay, so it costs more to have a joint audit. So if we assume that the cost is, like Mazars said, 15%, but if we look at 2017, okay, there's $121 million, not dollars, euros, that were given from the companies to their auditors. So they paid more in the economy, $121 million more. If you think it's 30%, it's the double. So more than 200 million euros that are given from the companies to their auditors. So that's a lot of money in the economy. So there's a share that is given to the auditor. Why? We said that there's no increase in quality and no decrease. Okay. Then is it the subsidies to the auditors? Maybe. Okay, but there's a cost. So that's a decision that is made by the government to have this here. Then if we look at the wealth transfer now from the Big Four to non-Big Four, we don't have statistic on this, but we know that in France, the non-Big Four have more mandate than in the rest of in the other countries where they have single audit here. So it means that there's part of that share that they receive more than the Big Four receive. Maybe that's why you can understand the comments that were provided to the European Commission, okay, when they talk about the joint audit. It also depends on the proportion of the fees that the non-Big Four get when there's a mixed pair. Okay, when there's a mixed pair of auditors, the proportion of fees from the non-Big Four is about 30%. Okay, so it means that they receive 30% of the share of the euros that the companies paid for their audit here. So there's a kind of a wealth transfer from the Big Four to the non-Big Four in France. That's a fact. We don't know the amount, but that's a fact of the transfer. So that's kind of the political decision. We're talking about politics before, okay? Some win, some lose, and the government has to decide who will win and who will lose. And that's a decision that has been made in France in that case. And if we move to a joint audit in other country, that's the type of thing that will happen and the type of wealth transfer that will happen in these countries. Any surprise with this number?
I mean, if you put it in the context of how big fees are, especially for bigger firms, I'm actually not sure whether the fee as such is really an issue, right? In terms of imposing administrative costs on firms with, increased audit intensity, if that is the effect.
It's a good point, because for the audit firms it's a big amount of money. Okay, for the companies, yes, audit fees are very small proportion of their income.
Exactly.
Okay, it's very well, they always complain about the fees, but when you look at the amount compared to the income, it's very low. So it's not that much an issue, even if they go and ask for lower fees. But it's not a big issue for them. That's kind of what the EC said in their study of the competition.
Maybe I could add something here. I remember what we know in the academic literature is when you change your auditor, usually the companies pay lower fees to the new auditor. It's this lowballing issue. So I think that companies care a lot about the fees they pay, in fact. Because what's the point of paying, trying to pay 10% less, okay, when you change your auditor, and saying, here, it's not an issue, Jan? You see my question?
Yes, thanks, yeah.
But yeah, it's always an issue, okay, because you don't want to give money when you can pay lower. But it's not a big part of their income, okay? It's small, but they subsidize, okay? They subsidize the auditor here, the companies. Then on the other, like we said, the big four not subsidized, but they transfer part of their share of the market that they have in other countries to smaller firms. And we see
I mean, if the quality would have increased to 30% as well, right? I mean, the market would be informed so much more. So then I would even be, very glad with this result.
Yeah, right now we don't see an increase in quality, okay? And then is there a systemic risk? There's question as to whether one of the small firm will be able to perform the audit of the other if it happens, okay? Maybe if you have two big four, it's okay, but when you move from a big four and a smaller firm, it raises question as to whether they will be able to do it, okay, in many cases. Maybe when there's mass, it's possible, even depending where in the world the company is, but I think that's another issue. So there's no clear benefit, okay, in terms of the market, okay, and there's a cost. And this cost that is paid more by the company, and there's a transfer of wealth from big to non-big four. So like I said, there's a lot, we see that, we understand now why it's a political issue here. It's the same thing, same type of issue that we had and they had in France when they decided whether all companies should be audited, even the smaller one, or there should be, some companies should not be audited, okay? But many small firms were complaining that, and then it's an issue, it's really a political decision in that case that should be informed by research, okay? But then in the end, you make a decision, and these are the cost and benefit that we see from this decision that was made in France, without necessarily the benefit, like you said, yeah.
We got a few more minutes, I guess, for the presentation today.
Okay.
The time is running very fast.
Okay, so we're there. Summary. I'm sorry. So what does the literature show us? Like I said before, less concentrated. Okay, one firm was able to grow. Okay, to compete the big four in the French market. No significant benefit, higher cost. We see that there's some political motivation. Okay, it's not only an issue of cost or quality, but there's also a kind of protectionist, being able to have large French, and they were saying here, large French companies or auditor firm that will raise and be able to compete globally. And we said that there's one that was there. In terms of systemic risk, 76% of peers included a non-Big Four. So again, if a Big Four disappear, will those firms be able to do the audit for those firms? That's a question here that we don't have the answer, but should be looked at. In terms of application, for investor and regulation, well, we talked about the political motivation, so it plays an important role. Okay, and it was said before in the discussion that we had. Okay, the result might differ in other contexts when we're talking about Italy versus France or what. We know that in France there's a ban on non-audit services for the auditor. There are mandatory 6-year contracts, and there's a lot of other issues that are there in France that makes the result may be not comparable or not applicable to other countries. So we really need to look at the institutional context to be able to decide what should be done in one country. For researcher, okay, we always want to inform the policymaker, okay, based on our research. What we said before, we need more research, more recent research, but we see that there's not only the economic type or consequence that we have in terms of research, but there's also the idea that the politics that's involved. And I remember a paper that was like a market for excuse in terms of research. So what do regulators take in terms of research result to be able to sell their policy here? So we have, as researchers, we have to be aware that there's not only the economic base, but there's the political part of it. And maybe we should also look at this political process here. And it might explain why the participation of the academic in regulation is low, okay, in the consultation process. And maybe we should be more there. There's more and more research or paper on the idea that we should, as academic, be more involved in terms of the regulation. I know that in the US with the PCOB and the SEC, they have to base their policy based on research. So they cite working papers and research that has been published in their regulation. We don't see that necessarily in every country. So maybe we have a role to have here, not only in terms of paper, but also responding to those comments. There was not too many academics that responded to the EC call on their proposal for the joint audit, okay, 10 years ago. So maybe we should be more there. In terms of research, during the presentation, we talk about many issues that should be researched. So here's some other that we have here, we propose. Like I said before, the quality of the financial statement is not only caused by the auditors, but also by the companies, meaning the other elements that are in the company, talking about the quality of the governance system, the internal controls, and even the regulation. Okay, so how does those elements interact with joint audit? Can we have those elements and not have joint audit instead, or what is the interaction between the two? What is the role of the auditor legal liability on joint audit? We saw that when we discussed before about having the share audit versus joint audit, the idea was that if you have the share responsibility and legal liability, it might be different than just taking the responsibility as yourself. So what is the impact on the pricing and quality of the joint audit that is performed? And an interesting issue that we discussed a little bit in the presentation is why did Mazars was able to grow and not the other? So what are the factors that affect the development of second-tier firms, and what is the effect of the economic and regulatory environment on their market position? And how does joint audit might help, or what other factor might help those firms to grow? Okay, do they need help first, and do they want to grow? And finally, more in terms of technical issue, like I said before, large companies choose Big Four, okay, or larger auditor. So what is the impact of this kind of self-selection, okay, of the peer auditor on the quality of the financial statement, the quality of the audit? And in terms of our result, okay, is it caused by the peer of the auditor or just a selection of the companies that with certain characteristics that have better audit quality, that have better financial statement, with we assume that is better audit quality or similar audit quality here. Thanks for your attention and thank you for your participation. It was very, very interesting to discuss this issue with you and to hear what you had to say. I don't know if you have any other question or comments that you want to raise at this point. For our part, we're done with the presentation.
So if someone still has a question, please raise it. It's we know that we are over time a bit, but I think we had a very lively discussion. So I can imagine that some people still have a question. Is there anyone?
If you have any comment or anything, don't hesitate to send us an email. We'll be glad to respond or to discuss this issue with you.
Yeah, I really want to thank you, Jean Alain, for presenting this. The results of your research, which I think is incredibly interesting, and given how the audience were responding, they think the same, right? It's like what David said. Maybe we are not always on the same page, but it's a very important, interesting discussion, right? Which it is, and this is a very important, I think, a very important paper in that respect, because it's it's solid research, and it helps us really better understanding what is happening, both from an economic point of view, and like you said, also from a political point of view. And during the discussion, there was also reference to recent developments, which might again challenge what is happening. So we're not done yet, I guess. But it's I really enjoyed the discussion, and given the line here of people responding, I think we should be very, very glad with how enthusiastic all the people are with with what you have been presenting and put into discussion. So thank you very much for this. I really enjoyed it, and indeed, if people also from the regulators, or if you want to respond on this, because that is also helpful to us researchers, right? If you give your points, that these are very helpful for us also to further improve our research questions and what we should be asking. So please feel free as much as possible to reach out to Alain and Jean, and you can also reach out to FAR. Then we make sure that Jean and Alain will know. So please feel free to do so. But again, I would like to thank you very much. I would also like to thank Alex and Esther for organizing all this, because we would not be sitting here without them. So thank you for that, Alex and Esther. I mean, that was really great, for all your help. Thank you for that.
You're welcome.
Yeah. I also want to thank the audience, because you were extremely active today, and that is, that is to our benefit, because I'm sure that Jean and Alain have been helped also a lot by your questions, the questions that you raised, new insights for their research. So thank you for that. This is exactly how we would like to run each of our masterclasses, where there's lots of interaction, and even sentiment, which is good. So thank you for that. With that, I would like to wish you all a very nice weekend, and hope to see you back in our next masterclass, and see you then. And thank you, and see you next time. Thank you also, Alain and Jean. Have a nice weekend. Yeah, in Dutch even. Thank you. All right. Have a nice weekend.